When the circumstances of the Chinese-British negotiations started and people started to worry about the future, they wanted to move money out of Hong Kong, there was nothing the government could do. The system was fundamentally flawed. The question seems to assume that Beijing can tell Hong Kong what to do in the monetary area, but it can't. Beijing does not direct or advise Hong Kong in monetary policy.
Your situation is like, okay, just a private citizen, just write a paper, very strong argument, and then they just use your method.
As I said, the Hong Kong government at the time didn't have any solution. But the Hong Kong dollar is very much my baby.
Today, we are honored to be joined by Mr. John Greenwood, a distinguished economist best known as the chief architect of the Hong Kong dollar currency board system. His work laid the foundations for one of the most enduring and resilient currency pegs in modern financial history. Mr. Greenwood is the founder and chief economist of International Monetary Monitor Limited and served for the decades as the chief economist at Invesco. He graduated with a Master of Arts from the University of Edinburgh in 1970s and then pursued postgraduate economic research at Tokyo University from 1970 to 1974 before beginning his role in Hong Kong. In the early 1980s, during a period of severe monetary instability in Hong Kong, Mr. Greenwood was instrumental in designing and implementing the currency board arrangement that pegged the Hong Kong dollar to US dollar at a fixed rate of 7.8. This system, introduced in October 1983, remains in place today and has been praised globally for its transparency, credibility, and robustness, even in the face of crises such as Asian financial crisis and global financial crisis. Beyond Hong Kong, Mr. Greenwood is long-standing proponent of monetarism and has written extensively on the role of money supply in influencing inflation in economic cycles. His work has shaped thinking in central banking and currency management across both developed and emerging markets. Please join me in welcoming a true titan in monetary economics, Mr. John Greenwood.
Thank you, Boon.
Let me start with the first question. Take us back to the late 1970s and early 1980s. You had just arrived in Hong Kong from Japan and the city was going through a period of financial uncertainty. Can you share with us what brought you to Hong Kong at the time, what your role was, and how you became involved in proposing a revamp of the monetary system? How did it ultimately lead to creation of Hong Kong Currency Board and the fixed peg to US dollar?
I've been doing postgraduate research in Japan and I wanted to get a PhD, but eventually the university told me that unless I was going to teach at Tokyo University, it really would not be feasible to get a PhD. So I decided, based on my research, that I knew enough about what was going on in financial markets to branch out into the real world. Some of my articles drew the attention of investors in Hong Kong, and I was invited to visit Hong Kong, whereupon I realized that the kind of monetary research that I was doing in Japan could be extended not only to Hong Kong, but many other economies in Asia. And that was an exciting proposition. So I decided to move from Tokyo to Hong Kong. The involvement with the currency in Hong Kong came somewhat later because I arrived in Hong Kong in 1974, and the currency crisis did not occur until 1983. But in the meantime, I was trying to understand how the system worked. And it wasn't really till 1981 that I figured it out. There was no textbook or anything. And the authorities were not at all transparent. They didn't disclose anything. Even the reserves of Hong Kong were kept secret. So it was difficult to figure out what was going on. But eventually I did. And I made various proposals in a journal that I started editing called Asian Monetary Monitor. As a result of 2 or 3 essays that I wrote in that journal suggesting how the Hong Kong dollar system could be reformed and improved, that I came to the attention of the authorities. When the crisis occurred, they really didn't have a solution, whereas I did have a solution. So they called on me and I gave them my advice. That's really the story.
So what happened is that you wrote an article and people from the government just read about it and they know that you have a solution and this engagement started from that point. Is that how it works?
It's a little more detailed and complicated than that. I'd written an article in 1981 and I'd been summoned by the government because I said that the currency was in danger of falling, depreciating sharply. And they summoned me and said, look, you are effectively being disloyal to Hong Kong. This is undermining stability and financial markets. And I said, well, if you can show me where the principles underlying my analysis are wrong, then I'm happy to withdraw it. But they couldn't. They criticized me for one or two factual errors. And at the time I said, well, you don't disclose anything. So I've gone on what information is available in the financial press. That's all I can do. That was 81. And it wasn't until 1983, 2 years later, by which time I'd done more research and talked about the system with some quite distinguished academics. I mean, I talked about the system with Milton Friedman, who was a personal friend of mine. With Maxwell Fry, who was a well-known developing market economist, and he was at the Asian Development Bank. And I also talked about it with Alan Walters, who was the chief economic advisor to Margaret Thatcher, who was the British Prime Minister at that time. They all supported and approved of my analysis. So I knew that academically I was on very strong ground, but there was huge opposition from the government in Hong Kong, the bureaucrats, because it wasn't a political system. It was a colonial system of appointment, from academics in Hong Kong and from the banks in Hong Kong. So most people were against this. But in the end, the currency fell so sharply that they had to do something. And I'd been proposing two solutions. One was to have a central bank to fix the exchange rate, and the other was to have a central bank to manage the money supply. So controlling the price or the quantity. But the government rejected both of those on the grounds they weren't prepared to have a central bank. So my problem was how to fix the system, how to stabilize it without a central bank. And during the summer of 1983, I realized that it could be done using a currency board mechanism. And that's what I finally did. So I submitted a paper called How to Rescue the Hong Kong Dollar, 3 practical proposals. So I ran through the first 2 and said, I understand that although those would work, they are not acceptable. But there is a third option, and I outlined my proposal. And ultimately, that is what was adopted.
I'm holding your books here. So actually, I'm reading the 3 proposals that you just mentioned. Let's say we unwind a bit on how came to that stage, right? Because I think Hong Kong regime or the policy that they used before that was a peg currency. It was pegged to US dollar, and before that, maybe even silver and UK pound. Yes. So then there's something happened between around 1970s that just make the system stop working, and there's a lot of uncertainty, and there's a lot of the problem with the regime, right? And then on the other hand, people say that there's speculation say that all this is because people realize that 1997 Hong Kong will be returned to mainland China, and hence there's capital flight, right? Do you think between these two, right, actually which one is the main problem? Because by reading your books, I think it's the system itself is already have its weakness, right? And your proposal is the one that fixed that weakness. Can you walk through with us a bit more details for audience context?
Yes, sure. You're correct. My analysis was that the system was fundamentally flawed, and the reason for that I'll explain in a minute. But the trigger for the crisis, or the timing of the crisis, was precipitated by the Sino-British negotiations, that is the Chinese-British negotiations over the future of Hong Kong in 1981 to 83. So the political circumstances simply determined the timing. Prior to that, the flaws had been there, but because there was no urgency to move capital, there were no big threats, and there were various frictions in the system. The underlying flaws in the system didn't really come to the surface. Now, what had happened was in 1972, when the Hong Kong dollar was depegged from the British pound and pegged to the US dollar, instead of keeping the arrangement whereby banks, in order to issue banknotes, had to submit originally sterling, but obviously if you're pegging to the US dollar, it would be US dollars. Instead of keeping a system whereby the banks had to pay US dollars to the Hong Kong monetary authorities to issue Hong Kong dollar currency, they said, well, since the system is moving towards a floating system and we don't need that anymore, we'll just accept payment of Hong Kong dollars. So they broke the essential FX link between the issuance of Hong Kong dollars and a foreign currency. And that led to instability. The currency started to move a bit more. The government tried to intervene. The interventions didn't work because they were not a central bank. They weren't reducing the monetary base or increasing the monetary base. So they were just like a corporate customer trying to influence the exchange rate. If they bought Hong Kong dollars, that would mean that somebody else gave up Hong Kong dollars. They now had Hong Kong dollars. It didn't change the volume of Hong Kong dollars in the system, which is what you need, and conversely. So anyway, and then the second mistake was to allow the system to float from November 1974. So those two things meant that there was no longer any control over the price. That is, there was no connection with any fixed rate to a foreign currency. And there was certainly no control over the quantity. So Hong Kong was now adrift. There was no control over the price or the quantity. And the result was, when the circumstances of the Chinese-British negotiations started and people started to worry about the future, they wanted to move money out of Hong Kong, there was nothing the government could do. They had an open system. They couldn't have suddenly started to control it, and any intervention they did was useless. So they basically had to do something, because the currency started falling very sharply.
And they try to defend it by buying back the currency. It's just that it doesn't work. So therefore, they have to invent or come up with the new system.
Correct.
That was 1983.
Intervention was futile.
Intervention. Okay.
Yes.
So I think the system definitely played well. So it's already 42 years since the currency peg. So did you expect it to last this long? So many decades.
Well, in 1983, when my system or my proposals were adopted, I didn't have any time frame in mind, but I knew that the silver standard or the gold standard on which my proposed convertibility mechanism for the Hong Kong dollar was based, I knew that those systems had lasted many, many decades. In Hong Kong's case, the silver standard had lasted from the 1840s until 1935, so nearly a century. And at the time of the currency crisis in 1983, during those Sino-British negotiations over the future of Hong Kong after 1997, my scheme or my proposals were widely criticized for not following the fashion at the time towards floating exchange rates. After all, the Bretton Woods system had been abandoned between 1971 and 73, and numerous currencies were now floating. But I knew that fixed rates have always been best for a small, open economy like Hong Kong. So in terms of the duration of the system, the longevity of the system, in principle, there's no reason, in my view, why the linked exchange rate should not last indefinitely, provided the Hong Kong economy is allowed to adjust to the exchange rate. So you understand, if you have a fixed exchange rate, the economy has to adjust to the exchange rate, not the other way around. And provided that the anchor currency, the US dollar in this case, remains reasonably stable. So, for those reasons, I was quite confident the system would last, but I wasn't prepared to say it's going to last 42 years and 6 months or something like that. No. I had no idea.
So in your view, what are the key advantages of the current currency peg system compared to alternatives available at the time?
Well, first, the flexible exchange rate, which had been operating from 1974 to 1983, had proved to be completely unsustainable. I think I need to remind the audience that between 1980 and 1983, the FX rate for the Hong Kong dollar US dollar rate had depreciated from 550 all the way down to 960. I mean, that's a huge depreciation. That episode showed that in any future political crisis, a similar kind of instability could be repeated, and nobody wanted that. So a flexible exchange rate was simply not on the menu. Okay, so we've disposed of that. The second option would have been to have had a managed peg or a managed float, but that would have required continuous intervention by a monetary authority, which was at that time just a sort of department of government. It wasn't a separate agency. They didn't have staff and so on. So it would have required an elaborate central bank infrastructure at the monetary authority, which Hong Kong simply didn't have. So they didn't want to do that either. And I mean, that is still the case. If you adopted a managed peg or a managed float now, you would have to be prepared to intervene on a regular basis. And third, finally, pegging to any currency other than the US dollar is not really feasible or sensible given the structure of Hong Kong's trade and financial transactions. That that was true in 1983 and it's still true today. I mean, it wouldn't make sense to peg the Hong Kong dollar to the Japanese yen or to the euro. Trade with those countries is too small and capital movements now are pretty trivial. Between those two areas. The only other currency that's feasible is really the Chinese yuan. And the yuan, as you know, is not convertible. So you couldn't move funds back and forth in order to eliminate interest rate differentials or arbitrage any other differences. So those three options are still the same as they were in 1983. My personal view, as I mentioned earlier, is that for a small open economy, a fixed rate is best.
So let's say Chinese yuan they change their status, become convertible, right? So they open up the economy, Chinese yuan become freely tradable. If that happened, right, would you change your view in terms of the currency pegging? Would Chinese yuan be a sensible choice now if that happened?
If that happened, but my personal view is that that's not going to happen, certainly not in my lifetime. and I think it's highly unlikely to happen under the current Communist Party leadership system in China. That's a system which emphasizes control and allegiance to the party. But if you allow people to accumulate assets abroad and make them independent, really, of the party so they can direct or say and do things which may contradict the party, then you're undermining the system. So I just don't think that's got any chance of happening. So I don't normally put the CNY as a realistic proposal.
Just looking at the progress, I think Chinese yuan also moving, although it's very slow, but still moving slowly towards more and more opening up the financial, opening up all these controls, right? Isn't that so?
They are opening, but subject to control. For example, all of the north-south capital flows, they're called connect schemes. The Hong Kong Shanghai Connect scheme for stocks, for equities, the Shenzhen Hong Kong Connect, the Bond Connect system, all of those are carefully supervised and monitored by the authorities in the mainland. So that's really just a sort of, these are controlled flows, they are not free flows. Whereas what Hong Kong requires for equilibrium is free flows between the Hong Kong dollar and other currencies in order that those interest rates can sort of equilibrate or stabilize. That's not what's being offered. The other point to make is that the yuan is being used a little bit more for trade transactions, trade settlement, but not for capital movements. At the moment, something like 80-90% of capital transactions in the East Asia region are denominated in US dollars. So the yuan has a long, long way to go to catch up with that. And it's the capital movements which are really important to a system like this rather than the trade settlement.
So from time to time, right, the financial community speculates about Hong Kong dollar possibly depegging from the US dollar. What's the likelihood of a depeg occurring over the next, say, 10 or 20 years?
In my view, there's zero chance of a depeg from the US dollar, unless, as we were just saying, unless the Chinese yuan, the renminbi, becomes fully convertible so that the Hong Kong dollar can peg to the Chinese yuan. But pegging to a non-convertible or only partially convertible currency would greatly reduce the efficiency of the Hong Kong dollar linked rate mechanism. So I just don't think that it's going to happen.
So this is not like something like, let's say, the leaderships from mainland China just say that now Hong Kong, instead of like one country, two system, they just want to make Hong Kong become just another one of the Chinese cities, right? They can't just influence that way because it requires all these mechanisms to work, like what you just mentioned, the convertibility that is really required in order for the peg to work, right? Can you explain more to the audience so that we get more understanding on this?
Sure. Well, fundamentally, Hong Kong is designed and it's been agreed that it will be different. And all those differences are set out in the basic law, which was agreed by Britain and China in the form of a treaty in 1984. And it was passed by the National People's Congress, I think in 1992 or thereabouts. I don't remember the exact date. But anyway, it is a law of China. And that sets out all these things like that the currency of Hong Kong will be different. They will have free flows of capital. There will be no taxation by the mainland of Hong Kong, different fiscal systems. There will be the rule of law in Hong Kong, and the law will be the common law, and it has a system for appointment of the judges, and all that sort of thing, and the political system. So that the constitution of Hong Kong is set out in that. And it's quite a short document. Anybody can read it, and it's well worthwhile reading because it basically explains to you how a free market economy works. But that's really the source of the difference. And if all of that was to be overthrown, that would make a radical change to Hong Kong. And so it's simply, under the current arrangements, it's never going to be just another city of China. It's, as Deng Xiaoping expressed it, it's one country, but with two quite different systems operating. That second system is the system that prevails in not only Hong Kong, but also in Macau.
What has made the currency peg so resilient? A lot has happened in the past 4 decades, right? Because I'm thinking of is this just because the currency peg is in place, it's very easy for them to execute or implement the peg, right? They just have to buy and sell and just keep within the range, and it is very easy to understand for everyone, right? So is it just convenient that they just continue with the system and make sure that people just trust that the system will continue to work for stability's sake? Or is it really there are other reasons that make this peg very, very resilient that can last so many years?
Yes, you're right. There's a convenience aspect of it, but it's more fundamental than that. I would say there are two main factors which have made the currency peg resilient. The first is the willingness of the authorities in Hong Kong to allow everything in the economy, that is interest rate, asset prices, consumer prices, even the structure of the economy, what kind of industries there are and so on, all of that to adapt to whatever was necessary to keep the exchange rate at the fixed rate. So the fixed exchange rate is the overriding priority. If it requires higher rates or very high rates, or if it requires, that some whole set of industries goes bankrupt, then so be it. So the exchange rate is prioritized. Second, I would say the guaranteed availability of US dollar reserves to back up the entire Hong Kong dollar monetary base is essential. And that's an aspect of any currency board system. Just to, again, remind your listeners, the requirement that banks must pay US dollars at the fixed rate of 7.8 to issue new Hong Kong dollar banknotes. If they want to issue 780,000 Hong Kong dollars in banknotes, which is typical amount, so getting on for $1 million Hong Kong dollars worth of banknotes, they would have to pay 100,000 US dollars for the 780,000 Hong Kong dollars, right? They'd have to pay that amount of US dollars. So that requirement ensures that the HKMA, the Hong Kong Monetary Authority's guarantee, or what we call the convertibility undertaking, the CU, can always be fulfilled, because any amount of notes that exist in Hong Kong, if they come in for redemption, the HKMA is guaranteed to have enough money to repay that in US dollars. So there's always the US dollar there. There's never pressure. No, there's no shortage of reserves. And these fundamentals have been backed up by the various technical changes that have been made to the system first in 1988, second in 1998, and then third in 2005. The effect of those changes, which we don't have time to go into, but the effect of those changes was to extend the convertibility from the banknotes alone, which is what we started with in 1983 to 88, to extend that convertibility to the entire monetary base, which consists of the banknotes plus bank reserves, or the aggregate balance of the banking system, the bank reserves at the HKMA, plus any exchange fund bills and notes issued by the monetary authority. So the fact that the monetary base is always more than 100% covered by US dollars, and they can always pay that amount out as well as take in more, means that the system is always sort of immune from any kind of speculative attack. And there have been several speculative attacks, of course, over the years, but none of them have ever succeeded.
So we have talked about the benefits of this currency peg. Mainly, I think it's the stability. Now, let's talk about some of the downsides. What are the main downsides of this peg, in your opinion?
Well, I think the only downside to the peg is that there is occasional divergence between the business cycles in the US and in China. So, which one is Hong Kong going to follow? Well, nobody's making a decision on that in Hong Kong. But the peg means that Hong Kong is more likely to go the way of the US than the way of China. And there's been a fair amount of comment in recent years that maybe it's time to reconsider. But as I said earlier, the way to do that is to repeg to the Chinese yuan and away from the US dollar, but that's not really feasible. Because the peg necessarily keeps the Hong Kong economy more aligned with US financial developments than economic or financial developments in China. It means that Hong Kong is also subject to any conflicting or divergent trends in those countries. But overriding that, Hong Kong is also subject to global trends. And academic studies that have been done in recent years show that the US is still a bigger driver of global trends than China. And Hong Kong is more dependent on global trends than it is dependent on trends in the US alone or China alone. So at the moment, my judgment is that these kind of divergences between the US and China are not going to cause too much strain, or they're not going to cause so much strain that the authorities decide to abandon the system.
So this is effectively saying that the Hong Kong is ceding their monetary policy to the US, right? Because whatever, let's say like the Federal Reserve just cut the interest rate, they will cut. If US hike it, they will just hike the interest rate. It's basically the same systems, right? So is that a concern given that there's still more and more, I believe more and more Hong Kong economies is getting closer to China, given that now China is already growing a lot, right, as compared to like 40 years ago?
Well, yes, you're correct. In choosing a peg operated through a currency board, Hong Kong is effectively giving up any monetary policy. Hong Kong, or the HKMA, chooses to have a fixed exchange rate, not an active domestic monetary policy. It does not try to enforce interest rates that differ from the US. The HKMA, probably not well known, but the HKMA has a discount rate, and that is always set at 50 basis points over the lower end of the Fed funds band. So with the Fed funds band at 4.25 to 4.5 at the moment, the discount rate in Hong Kong at the moment is 4.75, even though the interbank rate is a lot lower. But the HKMA doesn't operate in the interbank market. That is literally an interbank market. It's not the rate at which banks can borrow from the HKMA. As long as the Hong Kong economy is more closely tied to global trends, as I said before, rather than trends in China, and as long as the Chinese yuan is not convertible and is subject to capital controls, it will make more sense to peg the Hong Kong dollar to US dollar, not to the Chinese yuan. So that's my view on if all those things come together, you have to think about all of them.
Yep, that's summarized well. If you were to advise mainland Chinese governments on Hong Kong monetary policy or whether to maintain the peg, what would your recommendation be? What's the argument that you would use to support it?
Well, according to the basic law, which, as I mentioned, is Hong Kong's mini constitution, the monetary policy of Hong Kong is entirely in the hands of the Hong Kong Special Administrative Region government, not in the hands of Beijing. The question seems to assume that Beijing can tell Hong Kong what to do in the monetary area, but it can't. Beijing does not direct or advise Hong Kong in monetary policy. Now, I've been a member of the Currency Board Committee of the HKMA for 27 years now, since 1998. That's the group which advises the HKMA on monetary matters. If you like, it's Hong Kong's equivalent of the Federal Open Market Committee in Washington. And throughout that period, there has never been any intervention or even any advice from Beijing about monetary policy in Hong Kong. So I hope that this separation of Hong Kong affairs from the mainland affairs, as provided for in the basic law, remains intact. So my advice would be to maintain the current system, maintain the one country, two systems, in which case, no, it's a decision for Hong Kong. And I think that the present system is the best of the available systems.
But Chinese government, of course, they can't direct it directly, but maybe if they want to influence it, there's still a way to influence it, right? After all, Hong Kong belongs to China. I'm just curious why there's no intentions from the Chinese government side to, say, change the system or make Hong Kong more embedded into China. So that's basically a bit political in terms of that question. Like, just that curious why it hasn't happened and why you don't see it over, let's say, the next few 1 or 2 decades.
Well, I think that it's fair to say that there's a high degree of professional respect between central banks for people operating at other central banks or monetary authorities. And you can see that between Beijing and Hong Kong because, for example, the real-time interbank settlement system, which was developed in Hong Kong, and it's a multi-currency system which handled Hong Kong dollars, US dollars, and Chinese yuan. That system was adopted or purchase. I don't know the precise arrangements, financial or otherwise, but that system was adopted by the People's Bank of China, imported from Hong Kong. So there's an example where Beijing is following Hong Kong, and it shows you that Hong Kong was a kind of a leader in this area. There are conferences between Hong Kong and China mainland economists and between the HKMA and People's Bank. In these gatherings, you can sense that there's full respect given by Beijing to Hong Kong. They don't ever, it's never suggested that the HKMA is some kind of a subsidiary of the People's Bank. As I say, it's one country, two systems, and the two systems are distinct, and the Hong Kong system is run from Hong Kong, not from Beijing.
So this is definitely the consensus view, right? People agree that this is two systems. It has operated like this for many decades. It's continued to operate. But I'm just curious, let's say if we look at the financial markets, right? Say, for example, the current peg is between 7.75 to 7.85. If we look at the financial instrument, we say, why not I just buy a put options, let's say on a strike at 7.75. If everyone agrees that this peg will remain, by right, this insurance or these put options should be close to zero, right? But it's not the case. So I'm just curious that is there like different kind of consensus between different circles, say for example, between monetary economists versus the financial markets. So what's your comment on this?
Well, there are many operators in financial markets, and the thinking on the mainland often differs from the thinking in Hong Kong. So it's perfectly possible for mainlanders to think that the Hong Kong dollar is very attractive because for various reasons at the moment, they might not want to hold renminbi. They might, where it's possible, banks or companies may be able to hold some Hong Kong dollars. So we do see episodes when the southbound inflows have been very strong, and that's what happened earlier this year in May when the Hong Kong dollar moved to the top end of the band and the banking system sold US dollars and wanted to obtain Hong Kong dollars. The HKMA was called upon to buy US dollars, and that created a lot more Hong Kong dollars, which pushed interest rates down sharply. But that was a market reaction. It wasn't the government or the HKMA saying we want lower rates, not at all. The circumstances then were that there were a lot of very large upcoming IPOs in Hong Kong, including, you'll remember the IPO for cattle, which was ultimately nearly, they took in, I think, just over $5 billion. So that the scale of that means there's a huge inflow into Hong Kong because many of those investors were outside Hong Kong, but they had to have Hong Kong dollars in order to subscribe to the issue. So there was a big inflow into Hong Kong at a time when Hong Kong authorities weren't, they never do anything about interest rates, but Hong Kong interest rates were not moving otherwise. So the effect was to push the exchange rate up. And then when the HKMA came in and provided additional Hong Kong dollars, interest rates fell to the floor, and they still haven't recovered fully. There's still a wide gap between overnight and short-term Hong Kong dollar interest rates and US dollar interest rates. Short-term US dollar interest rates. So, and there've been several times when there've been these kind of the divergences between short-term rates in Hong Kong and short-term rates in US dollar markets. That doesn't mean that the peg is not working or anything. It just means that viewpoints and perceptions are different inside and outside Hong Kong, and that kind of divergence can last a surprisingly long period of time.
That's the part that also puzzled me, because I think HKMA just print the Hong Kong dollar, flood the markets. It's just make sure that this peg remain, right? It's just part of the system. It is designed to work in such a way. And now, given that Hong Kong interest rate is so much lower as compared to US dollar, and anyone believe this peg will continue, they can just run the arbitrage, right? They will just long US dollar and then short Hong Kong dollar and just arbitrage the interest rate. So by right, that should bring back the equilibrium, right? But it seems that we are still not back to equilibrium. And sometimes if we look at the historical data, it could last quite a while, a couple of months, maybe even longer. So why the arbitrage is not closed within short period of time, which usually happen in other markets, which are a lot more maybe developed or different type of markets?
Well, I think it has to do with the fact that not only are the interest rates being arbitraged, but that the currency value is moving as well. So, both those things have got to happen. In the current situation, you've got to sell the Hong Kong dollars because the interest rate rates are low, long US dollars,
Yep.
right? But that's kind of contrary to what you want in the currency movement. So that kind of thing sometimes takes a while to work out.
So hypothetically, right, if the currency peg were to break in the future, what would be the most likely causes?
Well, I don't see any scenario in which the peg breaks. Fundamentally, I think such questions and such language imply a kind of misunderstanding of how a currency board system operates. Of course, my answer doesn't preclude a political decision by the Hong Kong Special Administrative Region government to change the currency system. That they could at some point introduce a central bank with a different set of objectives. But at present, I don't think there's any good reason for doing so. So, I mean, certainly market participants or market pressures aren't going to break the currency because they've got all the Hong Kong dollar, all the US dollars they could ever possibly require to match every single Hong Kong dollar out there in the market. And conversely, they can create as many Hong Kong dollars as they want to, so both on the supply side and on the demand side, there's no limit or no restriction on what they can do. So I think that nobody's going to break the system.
Yeah, actually, my last question, I just wanted to ask, like, let's say if such a scenario happen, right, do you think Hong Kong dollar will appreciate or depreciate? But I guess you already provided the answer to that questions, because it's a matter of willingness. As long as they say they will it, they say this will stay, then there's no reason to go either way, right? They have the reserve to back all the Hong Kong dollar, and on the other side can print unlimited. So it should stay this way. So that's your conclusions, right?
Yes, that's right. So if we just sort of sketch out the scenario, in a scenario where the HKSAR government shifts from a currency board, say, to another system, first of all, they would only shift to something they deem to be sound and stable. And then the movement of the currency would likely be trivial in either direction. If they were going to adopt a central bank and, let's say, manage the exchange rate, they would do it in such a way that, the movement was trivial. But I don't think they're going to do that. And in addition, in my view, the current currency board system remains optimal for a small open economy like Hong Kong. Whatever the circumstances are today, would not apply in some future scenario. And as I've said, we're not going to go back to a float. So, that they would never allow that based on what happened previously. So it's always going to be a tightly sort of managed or controlled system. Question is, managed in relation to what or pegged to what? I mean, it's not going to be allowed to fluctuate. Really?
This kind of like monetary economics or monetary policy questions, right? I believe because most people on the street, right? Let's say even we read financial news, we try to learn about all these topics. I guess it is just not something that people will pick up easily, because we don't need everyone on the street to come and set up monetary policies, right? It's only set up by a small circle of people. And based on what you understand, right? Or you read financial news, or you just talk to normal people like me, right? What are the things that people tend to misunderstood the most when it comes to this kind of topics?
That's a very good question, and it's an important question. I think what most people in the street, and this is also true for the majority of economists, is that they fail to understand the difference between a central bank that pegs its exchange rate and a currency board. Now, what I've outlined to you is the requirements of a currency board and how it's it's a very, very strong form of fixed exchange rate. The only stronger thing you can have is to adopt a different currency, right? Or to say, to dollarize. So if Hong Kong used the US dollar and didn't have any Hong Kong dollars, that would be sort of the ultimate, because a US dollar in Hong Kong would be the same value, the same as a US dollar in the US. The currency board basically means that the Hong Kong dollar is a different denomination of the US dollar. It's about, because of the 7.8 central rate, it's about 12 US cents per Hong Kong dollar. So there's what I've been stressing is that a currency board really only has this one single priority: keep the exchange rate where it is. That means they do nothing else. They don't do any domestic monetary policy. They don't raise or lower interest rates. They don't do open market operations. They don't set mortgage rates, or they don't, they don't know any of those things, right? But other central banks do that, and they lend to banks. And the result in a central banking system is that you can have the growth of money and credit, which is incompatible with the fixed exchange rate. So normally a currency crisis crisis occurs when you've had rapid growth of currency in that emerging market and tried to keep a fixed exchange rate. But in Hong Kong, that can't happen because the central bank or the monetary authority doesn't have the mechanisms to do open market operations. I mean, I guess it could introduce them, but it doesn't. Its priority is to keep that fixed exchange rate, and it does that by guaranteeing that that rate is always available to banks, either on the buy side or on the sell side, within those two convertibility undertaking limits, 775 and 785. And as long as that is the case, and they're prepared to tolerate the interest rate consequences, then really it's hard to see what can go wrong.
Only one job, right? It sounds quite easy as compared to other central banks. They still have to come up with have their own economy, study the markets, and then do the necessary changes that fit the current market environments, right? That's a different job.
Correct. Well, what they are doing is watching the economy and trying to adjust monetary policy to the economy. And that's not always easy. But Hong Kong, in a currency board system, it's the other way around. You fix the currency, and the economy has to adjust to the fixed rate. That there simply is no other alternative.
Yeah.
So as long as you're willing to, if you like, pay the price of that rigidity of the exchange rate and allow interest rates to do whatever they have to do, which may mean, that they're very high or they're very low at different times, well, that's going to be the priority.
I recall in your book, you mentioned that although if we just zoom into the short period of time, it sounds like it is not the right approach, say when they can't control the economies by, let's say, like lowering interest rate. But when we zoom out and look at the big picture, actually there's more benefits to this kind of tax system because it's stable, it's well understood. There's the benefits, right? So it is a price that's worth paying. So that's what you argue. Right?
Yeah, so the long-term benefits of that stability have paid off because Hong Kong has had, on average, very low rates of inflation, very comparable with Singapore, actually, not much different.
Yeah.
So, the system has served Hong Kong well. For that reason, I don't think that, despite all the speculation in the market, I don't think the authorities have any intention whatsoever of changing it. And we see that from time to time in the statements by the chief executive of Hong Kong, by the financial secretary in Hong Kong, and by the chief executive of the HKMA, that they all say that this is the system and we're going to stay with the system. You can see that if they ever indicated there would be a difference, then there would be huge speculation. So in a way, they're kind of locked into the current system, and it would be very, not difficult, but destabilizing for a while if they changed it. Because first of all, if they announced it ahead of time, people would speculate as to what the change was going to be. Second, if they change it, but don't make any announcement ahead of time, but suddenly change it on a Monday morning, let's say, then there would be speculation in the future that the system could change again. So either way, you set up instability. So that's what I mean by saying that, in effect, they're locked in.
Yeah, definitely. I think the system itself, the implementation is very important. I think things that is even more important is actually the credibility stuff, because all the financials is all based on trust, right? Now we all trust that this system will continue, better be this way for stability's sake. Actually, I have one more question, because when I studied this topic about currency peg, right, I understood that this kind of like pegging of currency and then suddenly there's a depeg situations, this is actually not new, right? Because I can give two examples. One is, I believe Swiss franc was some sort of peg with euro, and then in 2015 they lost the peg, right? Yep. And then there's a big movement in one day. Yeah, the other one maybe is Thai Baht, but I don't think Thai Baht is, I'm not sure whether it is like a rigid kind of peg in 1997, and then they got attacked, and then there's a huge devaluation. What is the difference between, let's say, like these two examples as compared to the Hong Kong one? Why one can fail?
Well, if we start with the Thai Baht, that was a central bank and they had a fixed exchange rate. So they had an obligation to intervene in the foreign currency. But they allowed the monetary system and credit in Thailand to expand very rapidly in 1995, 96 and into 97. With the result, there was a huge boom going on. And once you start a boom like that, imports grow very strongly and capital flows came in as well. In order to keep the Thai Baht fixed at that rate, they had to intervene in the market. And for a while, when the economy became overheated, imports became bigger and bigger and the capital inflows slowed. And the result was they had to intervene, so they started losing reserves. But then they ran out of reserves. Literally, I mean, the foreign exchange reserves went, if you combine with the the forward transactions they were doing. They went down to zero. So they were forced to devalue. So that's a case where you have this inconsistency between the growth of money and credit on the one hand and the availability of reserves to support the exchange rate. The Swiss case was a little different. There was no shortage of reserves. This was a case where, because there was instability in Europe, a lot of money flowed into Switzerland, pushing up the Swiss franc. And in this case, the Swiss authorities decided that the Swiss franc was getting too strong for the manufacturing industries, the exporting industries of Switzerland. So these companies, pharmaceuticals, engineering, and so on, were becoming uncompetitive. They couldn't sell. So they said, look, enough is enough. We're going to change the exchange rate. And they did a step change. So that there's a case where the economy, they were unhappy at what was happening to the economy because of the exchange rate. So they prioritized the economy over the exchange rate. And that's what required them to shift the rate abruptly. But these are the kind of conflicts you get, in central banking systems. I mean, Switzerland arguably could have avoided that by printing a lot more money, but they didn't want to do that either, right? Understandably, because they didn't want inflation. So they engineered a big change in the currency value and then said, we're going to keep this new value.
So it's basically there are many trade-offs, and then after considering all these trade-offs, they just decided to change, but their situation is not as rigid as compared to Hong Kong. All countries, all geography, all situations are very different. It's just that after considering all these factors, we like you just mentioned, you don't expect something like this will happen to Hong Kong, right? After, even if they consider the trade-offs.
Well, the parallel between the two, Thailand and Switzerland, is that in both systems, you're having to balance what's happening to the economy with what's happening to the monetary system. In a currency board system, the monetary system, the credit system is automatic. It just aligns with the monetary conditions in the country to which you are pegged. So Hong Kong financial conditions, by and large, have reflected financial conditions in the US until this May episode. But yeah, it's a trade-off between those two. And what I'm saying is that in the Thai case, it was the monetary system which was kind of a problem. In the Swiss case, they emphasized the desire for stability in the economy and were willing to sacrifice or change abruptly what was happening in the monetary system.
All right. Thank you so much, Mr. John Greenwood, for these lengthy discussions, teaching me a lot of all these monetary concepts. I really, really appreciate you coming to my YouTube channels here. Thank you so much.
Thank you very much. And I hope you get a good feedback from your listeners. Thanks a lot.